Out to Nour, is a market strategist at ADS Securities. He joins us live from Abu Dhabi. Good morning, Nour. Thank you so much for joining us. So you're actually quite optimistic in terms of what the ECB could be offering. You say the ECB could cut rates to 0.1%, the deposit rate to 0.1%, and with a conditional LTRO 3. Well, the ECB has traditionally been quite passive. Why do you think it's going to become more proactive all of a sudden?
Well, basically, in the past few months, we've seen the underestimation of the disinflation that we've seen lately. Basically, we are saying that the central bank has three options, but basically not all of these options that can be implemented in the next few months. But one of the main things that we believe that might happen is cutting the rates further to 0.1%. If things worsen, we can see further measurement or further measures. Basically, we'll start with a negative deposit rates side by side with an LTRO in order to force the banks or the European banks not to deposit these funds again into the ECB, just like what happened in LTRO 1 or 2. This is in case of if the things worsen further. Otherwise, the third options that the bank has basically is to buy government bonds, but we should not forget that if this decisions has been taken, the Germans basically, or the Bundesbank, would reject it or will oppose it. So, but for now, we believe that if things worsen, like from now until the end of February, in terms of the inflation figures, another decision could be taken in terms of declining interest rate again to 0.1, just like what happened also in Japan.
You say if things worsen. What exactly does that mean? How low will inflation have to fall in the Eurozone? Will it have to go to 0.7, 0.6%? And what about the tightening of the money markets? We've seen that of late, Ione rates spiking higher.
Well, basically, we're talking about around 0.5%, maybe or 0.4%. The ECB won't wait until the deflation came in or to hit the markets, basically. And Mario Draghi, lately, they say that ECB doesn't see a deflation. However, the current sentiment, let's say, or even the current emerging prices, maybe can show that the risk to the downside it remains for now. This is from this side. On the other side, have a look at the bond yields. Despite that, no major improvement in terms of the unemployment rate in Europe so far. However, the bond yields for Portugal, Italy, Spain, all of them are going down, despite that no major improvement in the unemployment. This is, of course, thanks to Mario Draghi and the ECB with their direct remarks about supporting the money market if the liquidity tightening, basically. So declining the bond yields decline, it doesn't show like that there's an improvement, because the ECB is doing the play or is doing the game in terms of supporting the market by remarks. However, these remarks might not continue for a long time if things worsen or if we've seen the inflation figures came in below 0.5%. At that time, we should see some intervention by the markets. And by the way, a few months ago, when the bank came in and cut the rates, nobody was expecting, or let's say, there's a lot of people that were expecting cutting the rates. However, if the ECB doesn't see that deflation risk, why did they surprise the market and cut the rates?
Hi, Nour. This is Norman from Hong Kong. And when you expect the ECB to ease further, besides inflation, do you also expect that the economic recovery was still shaky, or are they really targeting at the currency strength really?
Well, the currency strength, of course, it has one of the reasons, basically. But have a look at the unemployment rates, basically. The ECB is saying that it's stabilizing, but have a look at the numbers. It's not. We have seen the Spanish, the Italian, and also the French, in addition to Greece and Cyprus and many of the countries. There's no major improvement in unemployment, except, of course, in Germany. That's one side. The other side, we have also the currency strengthening, seen one of the obstacles, basically, and thanks to the Federal Reserve, basically, and start tapering starting from January. However, this tapering might not continue, because we've seen another surprise from the U.S. jobs report they blame it on the weather, basically, or the bad weather in December. Well, the bad weather was just only 2 days at the end of December, not for the whole month. So basically, right now we've seen kind of a risk of further measures by the ECB. That's right, and at the same time, we're not expecting the Federal Reserve to continue with the tapering process.
Yeah, anyway, that's you're sort of in the minority, that is for sure. But we'll certainly find out how things pan out. The statement is going to be quite interesting, the FOMC on January 29th. Nour, very nice to talk to you. Have a fantastic start to the day over there in Abu Dhabi. Nour Al-Hamouri of ADS Securities. And still lots more to come.